The world faces peak gold according to Goldman Sachs, but one geologist who's discovered more than 30 million ounces of gold says he knows where to find America's hidden gold deposits. Featured on the History Channel's How the Earth Was Made, this expert gold finder could be on the verge of a massive gold strike. Even a billion-dollar gold giant has engaged this small market cap company to use their proprietary technology. For the thrill of gold discovery with a new edge in Nevada, visit futuremoneytrends.com/gold. Greetings and thank you for joining us at futuremoneytrends.com. I'm here with a special guest today. Can you imagine getting to talk to somebody who's been in these markets as a professional, as a writer, as someone who's kind of done it all in the business, nearly 50 years. He's seen it all. And even he's saying, though, at this point, we are really in some uncharted waters, unprecedented territory. Our guest today is Joseph Meyer. He's the president of Meyer and Associates. He is the author of Straight Money Analysis. It's one of the premier newsletters out there. It's a quarterly newsletter, but you get the full package. You get his forecast, his analysis, and what he thinks you should be doing with your money. For nearly 5 decades, he has been personally and professionally involved with the U.S. financial industry. So I feel very lucky to be able to have a good 15, 20 minutes with him here today. Joseph, thank you so much for joining us.
Good morning, Daniel. Thank you for having me as your guest this morning. It's an extreme pleasure to visit with your listening audience. Thank you, Daniel.
Well, I appreciate that, sir. And I want to get right into this, especially right now. The last 4 weeks has been very volatile, and we possibly might even be seeing some pivots and some changes with the way gold is responding to the markets, the way the Dow Jones is responding to bad news, and I want to get into all of that. But you are a leader in privacy assets and wealth protection, and I think before we get into the markets and opportunities, I want to really focus on safety. And let me just name off a few assets, and perhaps with your 50 years of wisdom and experience, you could let us know what you feel comfortable with holding today. And of course, this isn't individual investment advice for anybody listening to this. But let's start off with the first one that most people will perceive as safe, and maybe it is safe, but cash.
Well, I think we all have to have adequate cash reserves. I think is certainly where we are in the economic cycle, and more importantly, what's ongoing in these equity markets. We all need some cash reserves, certainly to back up the positions we continue to hold in the other markets we find extremely attractive.
You know, I know you, on your resume, it showed that with the also insurance products, which is part of the financial industry, a lot of the Austrian economic blogs have been really advocating this Nelson Nash whole life policies. Do you consider that a safe place to be or for cash?
Well, I'm very concerned with the larger economic picture and the scenario that's unfolding as we speak as to where we are headed with these global interest rates, and more importantly, what we're going to face moving forward in the various global economies. I certainly don't like what's going on, honestly, in China. I'm not certainly very bullish on Europe with what's going on there. And I think, quite honestly, as I've said many times, these are unprecedented times we're living in financially and economically. And quite frankly, I believe we're in uncharted waters, which a lot of people at this point are finally starting to see and certainly starting to plan accordingly. Yes or no on whole life? I would say no.
Okay.
At this time, no.
Gold.
I think you have to be a long-term buyer. I think the precious metals possibly could have seen their lows, although we still have, I think, an outside chance of retesting them once again. But I do believe we're going to see significantly higher precious metal prices. And we could be seeing, I think, money come out of the stock and bond market due to the volatility we're witnessing in these markets. And more importantly, the uncertainty moving forward as to what the Fed will do, and more importantly, when they'll do it.
Do you, Joseph, for people who are interested in income, because that is probably one of the biggest things on any baby boomer's mind right now. Where in the hell am I going to get some income and not have the volatility? Where is that income today? I mean, is it single family houses? Is it in annuities? Where do they get that income?
Well, you're certainly not going to get it in the bond market. You're certainly not going to get it in these annuities. I think you've got to look to the equity markets, and, I've always been a favorite of the utility sector. I think you look at the quality utilities, you look at the good dividend-paying companies, you look at the low PE stocks in that sector, and I think that's certainly an area where investors can get in out of the rain and certainly bring some income to the table and possibly some long-term growth as well.
Joseph, with the last 4 weeks of 2016, it's really kind of thrown everybody off. Where the commodities are at Lehman Brothers lows, some of them even lower than after the 08 crisis. With the dollar rallying versus other major currencies, and the U.S. kind of still in this fake it till it makes it recovery. What is your view right now of 2016? Is the U.S. going to go into an official recession? Because I know as far as Main Street's concerned, we're still in the recession from 09. But as far as economists are concerned and the Fed, do you think we're going to enter into an official recession?
Well, I think to answer your first question, I think the commodity sector is making a very important long-term bottom, and I think the dollar's making a very important long-term top. Having said that, I don't believe we'll re-enter certainly a pronounced economic slowdown. I think the Fed will certainly fight any economic weakness tooth and nail. And I know people are looking for additional interest rate hikes as we get into 2016 and possibly beyond, but I don't believe that. I think we see zero interest rates once again, Daniel, before we ever see 1%. And quite frankly, I'm expecting the Fed to backtrack, honestly, from the latest rate increase.
When they do that, the QE initially was really good for the precious metals. But, essentially from 2011 to 2015, or even you could say 2016, the precious metals just, kept seeing lower lows. Do you think with a reversal would cause precious metals to rise or fall? Because this small interest rate hike, even though it's very small, actually has been really good for the precious metals so far.
Well, if you go back historically, we've had periods in the precious metals where precious metals moved in lockstep with rising interest rates. I don't know if that's going to be the scenario as we continue to move forward. Certainly time will tell. But I've got to believe at some point we're going to see a QE4. We're going to see additional stimulus put into the markets. I think it's necessary, and I think it'll happen. More importantly, we've seen coming out of the ECB talk of additional stimulus and quantitative easing, and I think most likely we're going to see a coordinated effort by all the central banks of the world to reflate this very troubled and declining economy. And if they don't do it, I think we could enter some very difficult and serious times.
To what end, though? What is these central planners' game plan? I mean, okay, so inflate it up again, and then as soon as they take their foot off the gas, we're going to be right back here, aren't we?
Well, that's exactly what's going to happen. They're going to kick the can as far down the road as they certainly can. The weakness we see coming out of China is affecting all these markets. The weakness we're seeing in crude oil is certainly not helping, and I think at some point the Chinese will come in and certainly stimulate and do whatever necessary to certainly support their market and, more importantly, revive their ever-increasing weakening economy. So I'm looking for these markets to attempt to stabilize at these levels, and I think, quite frankly, we're in a rally mode in the equity market. And as I've said recently in a show that I've done, I think the surprise, Daniel, will be that these markets can rally further than anybody would want to believe.
It's a great point. That's traditionally how markets react. So, I mean, right now everybody's thinking Dow 10,000.
Too many bears, Daniel. We have too many bears currently to see that. Sentiment is very lopsided. We had a lot of bears pile on this decline very late. And I'd like to review quickly with your listening audience some areas that I think the Dow may have the possibility of rallying to.
Yeah.
I think first off in the Dow, we've got resistance 16,250, then 16,500, and finally 17,000. And in the S&P 500, I've got resistance 1,900, then 1,950, then 2,000 in the S&P. And in the NASDAQ, I'd have resistance levels first 4,600, then 4,700, then finally 4,900. And I think in gold, we could probably see 1120, 1140. And I think in crude oil, we could probably see on this move $32.50 to $35 a barrel. That's what I'm looking for, Daniel, moving forward.
You know, if they reach those points, though, I mean, what is when you say this market can go higher than people think? I mean, are you talking about Dow 20,000, Dow 25,000? I mean, is this?
I think we could have an outside chance of going back and retesting the old highs, which, as you know, was 18,351 in the Dow, around 2134 in the S&P 500, and around 5164 in Nasdaq. That's what I think no one's expecting, and I think it could happen. Surprise an awful lot of people.
Well, and trading markets for 50 years, I imagine what most people aren't expecting is what usually occurs, correct?
Markets always do what people don't expect to happen for reasons that people don't believe. So I don't think it's going to be any different this time. But, you know, bull markets go through, I think you've heard this before, 4 phases. They're born on pessimism, they grow on skepticism, they mature on optimism, and they die on euphoria. This market, in my humble opinion, never died on euphoria. We never got the final blow off top. We never really saw the frothiness and excessive valuations that usually point to an ending of a bull cycle. So I think the surprise is we go back to the upside, maybe go back to those old highs a lot sooner than people expect.
Now, because we're in such uncharted territory with the Federal Reserve and central planners so involved in our markets, do you think it's possible that we won't even go through the cycle? Because the cycle is now broken with the Fed buying S&P 500 futures, with them just heavily involved in all aspects of the market fundamentals, the market numbers that come out. Perhaps we won't go through a cycle. Is that something that you have thought of?
I think that's an excellent point. I think it's also a very valid point, and I think it's the reality of the times we're living in with the intervention we've witnessed in all these markets that's worsening by the day. So I think when you talk about intervention in the markets, and I've spoken to this in previous shows that I've done on radio and TV, a lot of people don't realize we had intervention in the markets going back to 1980. That's when I first became aware of it as a Wall Street professional. In 1980, Daniel, we had a piece of legislation that was titled the Monetary Control Act of 1980. I don't know if you ever heard of that, but it was an executive piece of legislation that was signed by President Ronald Reagan, and I believe it's still on the books today. And what the Monetary Control Act of 1980 basically stated was the government could intervene in any market at any time for any reason. And as we know, since 1980, they've been doing it and doing it more frequently. So again, I couldn't agree more. I couldn't have said it better. That's what I think is ahead of us, and that's what I think most people at this point can't accept.
For mining shares, is this something that you're starting to look at? I mean, have they bottomed? They've been in a severe bear market for quite some time.
I think we've seen the bottom. Doesn't mean we won't retest it, but I think the worst is behind us. I think you buy the quality miners, you buy the leadership, you buy the good dividend-paying miners, and you put them away.
Excellent advice. If someone would like to reach out to you, Joseph, and subscribe to your newsletter, where's the best place for them to go?
Go to the website, straightmoneyanalysis.com. There's a full sample issue of the newsletter on the website. You can sign up for the newsletter right on the website. We have a secure PayPal terminal. We also accept checks and money orders. And as we speak, Daniel, I'm working on the next issue of the newsletter, which will be the March 2016 issue. And as a courtesy and out of respect to you and for what you've been doing and hopefully will continue to do, if anyone becomes a subscriber to the newsletter from the show we did today, I will give them a full 1-year subscription at the 6-month subscription price, $149.95. And I'll give as a bonus, additionally, all the back issues that I had written, which would be 4 for 2015. And all they have to do to get this special bonus and offer is when they sign up for the newsletter, put under merchant comments, Daniel Amaturi, and I'll know they came from the Future Money Trends show, and we'll credit them with a discount. We'll send out the latest issue of the newsletter immediately.
Well, it doesn't get any better than that, and we'll definitely email that as well. So thank you so much. Joseph Meyer, president of Meyer & Associates and the editor of Straight Money Analysis. You have a great day, sir.
Thank you so much for having me, Daniel. It was an extreme pleasure. Thank you so much.